All right, everybody. What is going on, everybody? Hope you're having a great start of, believe it or not, June. It's crazy to think we're already into June and into summer. Super excited about that. But with all that aside, you guys, if you haven't met me yet, my name is Adam Lang. I'm really excited and just appreciate you guys for taking the time to be with us tonight. I'm going to introduce my co-host, Ben Adams, here in just one second. He's one of the top mortgage professionals in the entire country. But today's updated webinar is really built all around just one big question. We've been doing these webinars on every other week for quite a while now. And one thing that keeps coming up over and over again is this word affordability.
Yeah.
Big part of this is just how are buyers actually making home ownership affordable in Denver right now? Because again, with today's prices, interest rates, nonstop headlines going on right now overseas, a lot of people are wondering, does buying even make sense for me right now? And tonight, Ben and I are actually going to walk you through exactly what's working right now in the Denver market when it comes to affordability. But quick note before we jump in, if you guys notice, if you're on a desktop tonight, on the right-hand side of the screen, you're going to see a chat button. And if you're joining from a computer, you'll be able to see this. If you're from your mobile device, you may or may not be able to access this. But as we move through the content tonight, feel free just to drop any questions you have in there at any time. We'll try to answer those right then and there if possible, but if not, we'll make sure that those are the first ones that we answer in the live Q&A at the very end. So with all that being said, though, you guys, really excited to dive into this and introduce my co-host, Ben. What's up, buddy?
Hey, well, thank you again for having me on. I love hosting these, co-hosting these webinars with you because it's so important. I was actually having a conversation with a potential home buyer earlier this afternoon, and she made the comment that I don't know if right now is a great time to buy. And I was like, you know what? If you're a buyer, this is actually one of the best times to buy in the last 15 years because buyers finally have more leverage than they've ever had. It doesn't mean that there aren't some challenges and there aren't some hurdles in this market, and that's what we're going to talk about tonight.
Absolutely. Well, with all that being said, let's just jump right into it. Respect everybody's time. I know I see a few people still joining, so as you guys join us, welcome again. My name is Adam, my co-host Ben. Let's just dive right into it. So again, affordability. Affordability is without a doubt right now becoming the #1 challenge for buyers in Denver. Most people, like Ben just alluded to, what they don't realize is there are actually a lot of very real ways to still make it work. The market didn't become impossible in 2026. It's just changed. And the buyers who understand just how to adapt are still getting great deals done. We're seeing this every single week. Most buyers right now, they're either waiting or they're guessing. And that's exactly why they keep missing these opportunities that are right in front of them. You don't need to rush, but you do need a game plan. And the best homes always go to buyers who are just ready before they ever even tour property. Timing doesn't beat strategy. Confidence, however, always beats guesswork. And preparation is what really saves buyers real money. That way, when the home does pop up, you guys are already in a position and you're ready, and you should already know at that point what that next move needs to be. So tonight, guys, we're going to go through some of these exact strategies that Denver buyers that Ben and I are working with on a daily basis, what they're doing to lower their payments, how they're actually still able to compete and successfully win. And if you guys just understand a few of the things we're going to be going over tonight, you guys are going to be in a completely different position than 90% of buyers out there. A lot of the stuff that we're going to cover tonight starts with one big part of all of this, which is financing. Obviously, affordability and finances go hand in hand. So Ben, I'm going to have you kind of dive into that first. But before we do that, let me just kind of brag about my co-host here for a second, just real quickly, a couple highlight points about why Ben is just such a great guy to listen to when it comes to this topic. Over 22 years of experience, well over $300 million in home loans, probably closer to 800 families at this point for helping them achieve home ownership. And I think my favorite of all of these, though, is just that you practice what you preach. You're an active real estate investor. You have a lot of great rental properties in different states. You're just actually doing what we're talking about. And I've seen it over the last few years, how much that has dramatically improved, not just your personal life, but everybody around you, your family, your friends, your kids, everybody. So just really, really excited and appreciative of you being with me again tonight, man.
Well, I certainly appreciate that, Adam. And I had to overcome some of those same fears and challenges when I started my home buying journey. So if you're someone that doesn't know if right now is the best time to buy, if you have concerns and maybe there is some fear and you're being hesitant, I know how you feel. I've been there. Now, let me introduce you, Adam. So why listen to Adam? Well, Adam is a 42-year Colorado and Denver native. He recently ranked 5th out of 344 Denver agents in sales volume. That is huge. especially in this challenging real estate environment that we're in. He's also a certified real estate negotiation expert. That is so important because a lot of these strategies that we're going to discuss tonight, they require some high level negotiating. And there are a lot of agents out there who are afraid to negotiate. They're afraid to ask for sales price reductions or seller concessions and actually do some real professional negotiating. Not Adam, though. He's also a host of Living in Denver YouTube channel, and he's the co-host of the Pursuit of Progress podcast with myself. So Adam, welcome, and thank you for leading this once again.
Thanks, buddy. Yeah, for any of you guys that just joined, or if you haven't had a chance yet, on the right-hand side of the screen, you're going to see a chat feature if you're on your desktop device. I've noticed a few people that are on tonight, I think, are on mobile, so they don't have this ability to do this. But if you guys are on desktop, or if you have at least the ability to, leave a comment in the chat and just share with us, on a scale of 1 to 10, how confident are you feeling right now about buying a home in Denver? When I say right now, just over the next, year or two, how confident are you that that can be a reality if that is a goal of yours? So leave that again over in the right-hand side of the screen on that chat. And before we dive into, again, all that great finance stuff when it comes to affordability, just a quick, just 2-minute, just little highlight of just some of the stuff that's been happening recently. And to be transparent with you guys, I put this together for our last webinar. So this is about 2.5 weeks old. But in late last year, the median home price was right around $558,000 for Denver Metro. And that was actually down about 4% from the prior year. A lot of choices right now for buyers. Active inventory in Denver is continuing to increase. A lot of buyers out there, a lot of sellers out there, a lot of homes for sale, but very few actively qualified and engaged buyers. So if you are in that position, you guys have some really, really great leverage and opportunities if you can just get through some of these mindset shifts that the majority of people have right now. Days on market is still hovering right around 2 months, which is quite a bit longer than what we saw, just a few years back. And again, just a lot of opportunity if and only if it makes sense for your specific, situation that we can kind of go through again later. All right, so 3 strategies that we're going to cover tonight, you guys. First one, how buyers are lowering their monthly payments right now, today, even in June 2026, when everything else seems like the world's going crazy with war and higher interest rates. There's just so much noise out there. We're going to talk about how people are still winning. Also, just some of these hidden opportunities that most buyers are missing and what's actually working right now, but also a few things that we're going to share with you guys at the end that are not working, some really big mistakes to make sure you guys avoid. So, Ben, let's jump into this first one that you're really, really passionate about. You have a lot of great insight. Again, just affordability, and talk us through I'll let you take the stage. You just kind of
Okay. Yeah. Well, thank you. When you talk about affordability, there's really 3 different types of affordability. This first one that we're going to talk about is monthly payment affordability. So how do we make monthly payments more affordable? There's also down payment affordability, being able to get some of your down payments subsidized. There's grant programs out there. There are silent second mortgages. There's down payment assistance. There's also minimum down and reduced down payment. So there are ways to get the down payment affordability. And there's also closing cost affordability. In some cases, the closing costs can be several $1,000s, or in some cases over $10,000. You also have to pay for your homeowner's insurance, your property tax, your impound account, things that are not closing costs, but they're going to be due at the time of closing. And so how do you pay for that if funds are tight? Well, there are strategies, there are workflows, there are ways to get the seller to pay for some of this stuff. And that's where we're going to start off with as far as the monthly payment. Now, most buyers think their only option is to accept today's rates, but that's not entirely true. Rates right now, again, we're going to acknowledge some of the realities of this market. So right now, there are hurdles, there are challenges, there are concerns that buyers have. One of those concerns is that interest rates are elevated. We are not seeing the historically low interest rates that we were 5 or 6 years ago. Right now, the average 30-year fix is in the high 6s. But smart buyers are not accepting today's rates. They are negotiating seller-paid permanent rate buydowns or temporary interest rate buydowns, and that is happening right now. I had a closing yesterday morning at 10 a.m. at the Chicago Title Office in Westminster off of 120th and Pecos. And the buyer that I worked with, we did a 3-2-1 temporary interest rate buy down. So the interest rate that he got in the first year was in the 3s, and that's happening right now. So how does this work? What does it look like? on a temporary interest rate buy down, which is what we're going to go over here in a minute, what you're doing is you are using a seller contribution or a seller's subsidy to buy the interest rate down on a permanent or semi-permanent or temporary basis, depending on the actual loan program. So what you do is you get the seller to contribute or to pay for the subsidy to make your interest rate and your monthly payment affordable. So this right here, this is a temporary buy down calculator. You can see there's 3 different options. In the top right hand, there's a 1-0 temporary buy down. There's a 2-1 buy down in the top left hand. And down below there is a 3-2-1 temporary buy down. Now I'm going to go to the next screen because we're going to discuss each of these in depth here. This right here is what a temporary interest rate buy down looks like. So in this example, the note rate in the top left-hand corner is going to be 6.5%. This is on a $500,000 mortgage amortized over 30 years. In this middle section there, you'll see that the property taxes are $200 a month, monthly homeowners insurance estimated at $195, and there's a small premium there for the monthly mortgage insurance. So what happens though with this right here? So for this scenario, the seller would need to contribute roughly $3,800 or $3,856.74. And then in year 1 or the first 12 payments, that would bring the monthly payment down by over $321 a month. And so that will then make the monthly payment more affordable. That $3,800 though, guess where that goes? That goes right into the buyer's escrow account. It's literally their money. It goes into their escrow account with their mortgage servicer. And then that is what is used to subsidize that mortgage payment for the first 12 months. Now, if you're thinking, $321 is great, but I need more than that, or I want more than that, I want to make it even more affordable, there's a way to do that. It's called a temporary 2-1 buy down. So this is the exact same scenario, same loan amount, same note rate of 6.5, amortized over 30 years. This is what the total monthly payment should be in the far right hand side here, $3,607.51. So to make this scenario happen, the seller would need to contribute $11,379. So in this example, the seller would deposit or contribute $11,379 that would go into your escrow account after closing. So it's actually your money. It's in your escrow account, and then it's used to subsidize the buy down for the first 2 years or the first 24 months. So look what happens in year 1. The interest rate is 4.5% instead of 6.5%. And so by having it be 2 full percentage points lower, you're going to save over $626 a month for the first 12 months. Your mortgage payment, including property taxes and homeowners insurance, is going to be under $3,000 for the first 12 months. Then it's going to graduate to year 2 for the next 12 months. It's going to be $286, where you're then going to save $321 a month before finally in year 3, it matures to 3,000 or the 3,600 number. Now, I want to be very clear in that this is not an ARM. This is not an adjustable rate mortgage. This is a fixed rate product. So it is different. The payment will adjust, but it's still fixed. The interest is just collected in advance from the seller. And this is why I was saying earlier in the call here that you need to have a certified negotiation expert, because to make this happen, you have to have the seller contribute for the subsidy. And so a lot of times it takes a real estate agent that understands what your goals are, what you're looking to accomplish, but then they also have to have the confidence to actually make the phone call and do some negotiating. What's exciting though is that, because what Adam mentioned earlier, there are more listings right now, not just in Denver, but nationwide, than there are buyers. So there's more sellers than there are buyers. And that means buyers have the upper hand. So they are able to negotiate things like seller paid closing costs, price reductions, and concessions from the sellers for interest rate buy downs. This right here, this is a 3-2-1 buy down. And you're going to look at this number here, exact same scenario, same loan amount, $500,000, same interest rate, 6.5, same loan term, 30-year fixed. And you're going to look at that buy down fee and you're going to be like, $22,000. Like that might just seem so outrageous. I am here to tell you right now that this is happening in the Denver market right now. I had a loan very similar close last month. The loan amount was $512,000. We got $23,000 for the buyer. Did this exact same scenario. They did a 3-2-1 buy down. So if you look at this right here, year one interest rate 3.5%. The monthly savings is going to be $915 a month for the first 12 months. You're looking at a total mortgage payment of under $2,700. Starting in year two, monthly savings is $626 a month. Mortgage payment is still under $3,000. Year three, $321 a month in savings. You add all of that up, $915 a month in year one, times 12 months, $626 a month in year two, times 12 months, and then $321 a month times 12 months. What do you get? You get $22,361. So that is how much money you are saving over the first 3 years or 36 months. Now, one thing that I love about this temporary buy down strategy is this is a subsidy. And I shared this earlier. So that $22,000 is placed in your escrow account. So if for whatever reason you sold the property, or if you refinanced inside of the temporary buy down period. So in this example, 3 years, let's say that you refinanced after 1 year, or you sold the property after 1 year, or the loan was paid off. Whatever that prorated balance is, you get that money back because it's your money. This right here is not a cost, unlike a permanent rate buy down. It is a subsidy. So this is actually your money right from day one, even if you pay the loan off early, even if it's refinanced, even if you sell the property during the temporary buy down window, you get that money back. The reason I'm pointing that out is because there's no risk. So if interest rates do come down organically and you want to be able to take advantage of that, you can, because you will get this money back, unlike a permanent rate buy down. A permanent rate buy down is a cost. And so even if it's seller paid, it's still a cost. And once it's paid for, let's say interest rates come down a year later by a full point, but you paid up front or initially to buy the rate down, but now rates are a full point lower, you don't get any of that money back. So with this, you would. So it's a great strategy to hedge the market, and then to make that payment more affordable. And it allows you to kind of grow into the mortgage payment. Hopefully that income will increase. There's $22,000 here. Just think about it like this. You can apply that towards other debt. Maybe you have student loans, or you have a car loan that you want to get paid off. Instead of paying more on the mortgage payment, you can divert that to some of the other debt that you might have. So that way, when the temporary buy down window is expired, some of that other debt will be paid off. So it just gives you more control. It allows for more flexibility, and you're able to make things more affordable with this specific program.
Can I jump in really quick, Ben? I just think it'd be really valuable for everybody to just talk real quickly. And this doesn't need to be a drawn out thing, but there's this talk that a lot of real estate professionals have in different, webinars, different just social media posts about, we'll use this $500,000 home again as an example. Two scenarios. One is you have a home that's $500,000, and as a buyer, you offer them lower than asking price. You offer them $470,000, let's say. So you're offering them a price to buy the home that's $30,000 less than $500,000. So that's option one, scenario one. Scenario two, you still pay the full $500,000, but you have a seller credit in the form of, let's just use that same $30,000, and that can be used towards what Ben's been presenting. So those are two different scenarios. Everybody's got a different, unique situation. One might be better for one person than the other, but you at least have the ability to really do the math, especially when you have somebody like Ben that can crunch the numbers accurately and really show you, a year from now, 2 years from now, 5 years from now, which of the two options makes the most sense. But there's just a lot of just strength behind understanding how there are these two different scenarios. I don't know, maybe I'm not saying that perfectly, Ben, but maybe just a couple points that you might want to share about that concept.
It's a great question, and it's something that comes up pretty frequently in my field. And if you ask the average person, would you rather pay $500,000 for a home and get a $30,000 credit, like in the example that you just gave, or would you rather only pay $470,000 and not get a credit at all? And most people would answer that they would rather have the sales price be less, because that is just how we're taught. But a lot of times that isn't accurate. Now, I'm not going to come out, like you mentioned, and say that this is going to be right for every single person, because this is where the planning and the vision and the structure really do matter. It really does depend specifically on what your goals are, what your strategy, what your 3, 5, 7 year outlook are. But most of the time, the 500,000 with the $30,000 credit is going to make more sense. So from the seller's perspective, those are identical offers because the seller is going to net the same thing. On the 500,000 with the $30,000 seller concession, remember, if you're doing a temporary buy down, that is going to be put right in your escrow account. And so even though the sales price is going to be higher and that amount financed might be higher, you're still getting the 30,000. It's just put in your escrow account. So that's how I always handle that. The benefit of the reduction in sales price is that technically the loan amount or the amount financed would be a little bit less. But considering that it's not going to be that much less, and considering that the loan is still amortized over 30 years, the difference in payment would be very, very minimal. So with the other route, it gives you $30,000 upfront in the form of a subsidy. You could also use it to pay for all of your closing costs as well, on top of the interest rate buy down. And then you have that $30,000 that's in your escrow account if you're doing the temporary buy down, where you're gonna literally save whatever that dollar amount is. So in that example that I just gave, your monthly savings over the first 3 years is literally the $22,000 or $23,000.
Yeah, that's awesome. And guys, just before we move on, if you have more questions about this stuff, I know even for me that's in this every day, I still get confused all the time, to be honest with you guys. There's a lot going on here. So if you have more specific questions, and I'll have Ben put it in the chat, he has a link that you guys are always welcome just to book up. It's complimentary. It's just a 15, 30-minute, just whatever amount of time you need, but just a one-on-one with him, just to kind of talk through maybe more specific, unique scenarios that maybe you're faced with. Ben and I are open books. We just want to help as many people as we can. We're not trying to sell you anything tonight. We're just trying to really provide value, because that's needed now more than ever with how much, again, noise is going on out there in the world, with just everybody's saying it's doomsday. It's the worst time ever to buy a home. And those are the people that I guarantee you 5 years from now are going to have a couple friends that did take action right now. And because, again, I'll move on here in a second, but there's a great phrase to always remember. You make the most money on most real estate deals. Not all of them, but most real estate deals, you make the majority of your money on the buy, not the sell. So when you're able to buy at a really good time, an opportune time like it is right now, to have more leverage, to get more of these seller credits, to get the price of the home, both, get the $500,000 home down to 470 and get them to put in some seller credits. You have so many options right now. So much.
And you did that recently. You had some buyers that you got the sales price down and you got them a seller credit.
Yeah, this is not that hard to do right now, you guys. It was very difficult a few years back, but now is such an incredible time for buyers if, again, it makes sense with you. But just wanted to kind of throw that out there again, because it is such a great opportunity for a lot of people. All right, so this is one thing that I'm really excited to talk about. This is always one of my favorite parts of our presentation, and that's the hidden opportunities that a lot of buyers are missing. So this is just a few ways, maybe for anybody that's on tonight that is more of just a couch surfing, they're not out actively looking at homes with a realtor. Maybe some of you guys are in this position right now where you just like to, get on your laptop in the evening. Maybe you're watching the show with your partner, your husband, wife, your kids, whoever, and just on Zillow, just looking at some different homes and just, kind of getting a feel for things, getting the pulse of the market. Anytime you see homes that are sitting on the market for a longer period of time, and normally in a healthier, more balanced market, I would say 30 days. As you saw maybe earlier, I said that the actual average days on the market now is approaching, right around 55 to 60 days. So this number here, 30 to 45 days, maybe even a little bit higher than that. But when you see homes that have been on Zillow or just on the market for over a couple months, that's telling you a few things. These are hidden opportunities. And one of them is telling you that seller, most likely, not all the time, but most likely is going to be a little bit more flexible probably on their price. They might be more open and willing to give some of these concessions to help with a temporary buy down like Ben's been talking about, even just some of the terms in the contract, a lot of opportunity. So just make sure you guys are understanding that the longer a home sits, oftentimes the more leverage that you guys have. So again, where to find these homes that are sitting on the market for a long time. Anytime you see that a home has recently had a price reduction, that often is a good signal that those are motivated sellers. Or even if you haven't seen a price reduction, but you've seen that it's been on the market for, let's just say, 100 days and it has never had a price reduction, then that's also telling you that maybe they're just a stubborn seller, but also, they might be really in a point in their a point of listing where they are getting desperate and they're willing to budge a little bit more. So be really aware of that. If you guys are on Zillow, you can always scroll down towards the bottom. I have a little bit more advanced tools as a realtor that I can always provide you guys with too, but you can always scroll down and just see the history. The listing, went live on the market on May 1st, June 1st, price reduction.
Mm-hmm.
You see a lot of this just on Zillow, even just as a consumer. So make sure when you guys are looking at homes that you're serious about, scroll down and you can really dive a lot deeper into some of that other data and analytics. Another great opportunity is if you see listings that have just recently come back on the market. And this was one that I added to our presentation a couple months ago, closer to the beginning of the year, because especially here in Colorado, oftentimes what happens is if somebody's trying to sell their home, when you get into like the Thanksgiving time of year, that last 4 to 6 weeks of the year is the slowest of the entire year typically. So oftentimes people will just pull their home off the market at that point. If you pull your home off the market, you have to wait at least 30 days before putting it back on. So oftentimes people will do this. Sellers will take it off around Thanksgiving, then they'll put it back on the market in the early spring. You see this, again, you can see this by going down to that price history. That's another indication that that seller had a difficult time selling it before. You could also see what it was listed at previously. Did they relist it at the same price? Did they relist it maybe even a little bit higher for some reason? You have just more of this data in your toolkit and your tool belt just to able to navigate some of these things and realize some of these opportunities. And then the last one, this is, believe it or not, still very, very common. It drives me nuts, but it's just the poor marketing that is done on so many homes. So again, if you're on Zillow and you're looking at a home and it's just got horrible pictures, you can tell they took them with the iPhone, maybe even see, I don't know, a bed, maybe it's a home that the people are still living in and the bed's not even made correctly, or there's just junk everywhere. A lot of people that are on Zillow that see that kind of stuff, swipe, go next. They don't even look at the home because they're so focused on just the superficial, more visual type stuff. When you see homes that are like that, it still might have great bones. It still might be a great opportunity. So don't discount homes that you see that have poor marketing, poor pictures, that kind of stuff. It could just mean that they unfortunately have a really bad real estate agent that's not doing what they're supposed to do. And that could be another way that, why it's sitting on the market longer than maybe it should, and more opportunity for you, the buyer, when you identify that kind of stuff. So
I mean, we know there's a lot of bad agents out there because over 70% of real estate agents have not closed a single deal in the last 18 months. And there's a reason for that. And I think it's very easy to look at a property like some of the ones that you're describing, and maybe the photos aren't great, or maybe it's been on the market for 3 weeks. And it's so easy to ask, what's wrong with this property? And so that's where I'm training my buyers and the folks that I'm working with from because it's easy to go there. What's wrong with this? Or, why hasn't it sold? To, oh my gosh, what is the opportunity here? Or look at the opportunity. I wonder if I can use this specific strategy. Can they pay for my closing costs? Can I get that concession to make my mortgage payment more affordable? Because those are the properties that you are going to be able to do some of the strategies that we're talking about with.
Yep. And then let's now move into what's actually working. My favorite part of this, though, what's also not working. Not to be a pessimist, but I get a kick out of some of these reasons why things aren't working. So, what used to work coming in, let's just go back to 2019 when it was so nuts. People were coming in way over asking price, no contingency, meaning they weren't, probably even having a loan at that point to really be competitive. Back then, you almost had to have a cash offer. Waiving inspection, waiving appraisal, just no contingencies whatsoever. That was how you won deals, 4 or 5 years ago. It's not how people win today, though. What's working right now is just very clean, well-structured, well thought out offers that have not only strong terms, but flexibility, smart negotiation. It's not always just about the highest price that gets an offer accepted. Ben and I have a whole separate webinar, whole separate masterclass that we do where we really dive a lot deeper into this. So if you guys are kind of enjoying what we're talking about, make sure you guys stay tuned because we still host those every month as well. But before kind of passing it back to Ben, I just want to share one quick example of this when it comes to understanding that it's not always the highest price. And, unfortunately, there's a lot of reasons people need to sell their homes. It might be due to a divorce, maybe a death in the family. Maybe it is a family that has kids that are going off to college and they're going to be empty nesters. A lot of these scenarios, a lot of these situations are sometimes negative to them. They're not excited about selling their house because they're getting a divorce. They're not, there's motivations other than highest price for people to sell. And the best way to really take this and use this to your advantage is having a realtor. This is something I am really big on. Ben was kind of touting this earlier. Thanks for doing that, Ben. But just picking up the phone as a realtor, calling the listing agent and just having an open, honest conversation, asking them, what, would really best serve your client, the seller, to make this a win-win for both parties. How can we really structure an offer where not only does my client feel like they're in a great position to move forward, but also the other side. We always want to have a win-win, because then as it goes further into this contract to close phase, once you're under contract, it gets sticky sometimes. We have inspections, things always come up inevitably, even on brand new perfect homes. There's always things that come up. And when you have that win-win from day one, it's much easier to get through those challenging sticking points and still move forward, still come out on the other side, still being under contract and not having the whole deal blow up in your face. So just an example of this. So, I actually have that deal that Ben just mentioned, that we had some VA clients that we helped buy a home here in Denver. They closed on it just about 2 weeks ago. And by calling up the listing agent, I found out that this kind of example was what was going on there. It's a single mom, had a daughter that was, I think she was going into junior year in high school, but she really wanted to have her daughter be able to stay and finish out her semester at her school, because they were actually moving to a different state once the home sold. I was able to talk to the listing agent, find out about this. So then when we put the offer together, we included what we call a post-closing occupancy agreement. So basically what that meant was we were able to, for my buyer clients, to buy the home at an earlier date and then still let the current existing seller stay in the home rent-free for an additional, I think it was almost 3 weeks. And what that did was two things. One, it gave her a lot less pressure, where she was able to allow her daughter to finish the semester out. But I think almost just as important, maybe even more so, by having that closing date still earlier, before the post-closing occupancy began, that was the closing date. So that was when she received all of her money, her proceeds for selling her house. That then allowed her to then write offers on her new house in another state that weren't conditional, meaning that, what happens so often is you'll get an offer on a house that's conditional, meaning that there's a buyer that wants to buy it, but only if they can first sell their house. And anytime I have things, I always am hesitant to accept any sort of a conditional offer like that, because you're just hinged on one other factor that's out of your control that could, blow up the deal. So anyways, just a great way to get creative, find ways to still make it a win-win for everybody. And we were able to do that with that seller. Not only were we able to get it at a little bit lower price point, probably because she appreciated that we were doing this post-closing occupancy agreement, but then during the inspection, we were able to even get further dollar amounts, more seller credits during that part of the contract. And it ended up just being a great deal for my clients. And Ben is actually part of that one as well. So
and so you were, you were able to call the listing agent, ask some of those questions. You were able to check some of the boxes that were important to the seller and the listing agent, and you put that in your offer and some of the addendums. But then, I want you to expand on what that then did for your buyers, because the amount of the sales price reduction was significant, and the amount of the seller credit, I mean, it was a big deal. And I remember looking at the appraisal that came in, because it was a VA. We had to get an appraisal on the property. The appraisal came in substantially over what the actual sales price was. So kind of just talk about that briefly.
I think it was listed for right around 700,000, and I think we came in actually at 650, maybe it was 660. I forgot exactly, but we came in pretty low on our initial offer. Included, though, however, that post-closing occupancy agreement. And I think because of that aspect of the offer, it wasn't insulting to the seller. She was able to then, review that with her agent, and they ended up countering back. I think it was at 670. So still were able to get $30,000 lower on just the price of the home. And then once we were under contract, we still had our inspection phase. And during that inspection, we uncovered a few things that weren't major. They weren't what I like to call health and safety related, but they were still significant enough to ask for some credits. For example, they had a nice big deck off the back of their home, and it looked like it needed a little bit more structural integrity. So we were able to get a few $1,000 credit for that. So then again, all of that was on top of already getting it at a lower price point. So, and it was a smooth process from start to finish. It's only about a 3-week close. We let the seller again stay in the home for a couple extra weeks. And, during that time, I stayed in contact with the seller's agent, made sure the house was still, everything was going good, helped get their sprinklers turned on for the season, still, did everything that needed to happen. And the clients just actually arrived this past weekend, freshly cleaned vacant home that the tenant had, or the seller had moved out of at that point, and it was theirs. So just a really great, a great strategy.
Just so powerful. So because you were able to make that call and get some of those talking points and things that were important from the seller, and then because you had the confidence to write that offer, that initial offer at $50,000 below asking. I know a lot of agents who just wouldn't be confident enough to even write the offer. Mm-hmm. And being willing to do that, acknowledge, I want to get the seller what they're looking for, the things that are important to them, but I'm still here to represent my buyers. And my buyers want to write this at $50,000 under asking, and that's what we're going to do.
Yeah, I think some people might hear the way that I've been presenting that and think, well, hold on, if I'm hiring Adam as my realtor, he's looking out for me and only me. My best interest is important, not the seller's. Saying that as if I was the buyer. Yes, I 1000% agree. That's always, always, always the top, priority is our client. That is our fiduciary responsibility to protect and to navigate this entire process with our client, the buyer. But in order to really get it to the finish line, to make sure that we're really getting the most out of it, the way you do that is, again, creating that win-win relationship. And everybody ends up coming out ahead when that happens. Okay, so let's just kind of recap here. Buyers winning right now are doing things differently. They're lowering their payments with strategy, not just waiting on the rates to lower. They're finding these opportunities that a lot of other people are completely ignoring, and they're just writing these smarter offers, not just higher priced offers, but smarter ones that really cater to whatever is most important to the seller. So again, the market's not impossible. It just really rewards strategy. Now, before we move on to this live Q&A, I do want to share with you guys what I talked about, some of my favorite just the mistakes that we saw so much last year, especially in 2025, was happening over and over and over again. Not with necessarily our clients. We're still really adamant about not doing these things, but man, it's crazy how often you see some of these mistakes made, and some of them are pretty easy to avoid. So Ben, I'll do the first one. Maybe I'll let you do the second, and then I'll do the third one. So the first one is overlooking hidden costs. And I really probably should have let Ben do this first one, because there's a lot that goes into this, especially from a lending perspective. But just remember that, as you guys start to go out and look at homes, there's other costs outside of just the price of the home that you see on Zillow. For example, the one example that I'll use before, maybe Ben, you could probably share a few other ones when it comes to closing costs, HOA fees, that kind of stuff. But the one I want to share with you guys is property taxes. So I think at the very beginning of tonight's webinar, I noticed a few people that joined were from out of state. So every state's different when it comes to property taxes. Here in Colorado, they're based off of your property value, your assessed value of your home, and they do that every 2 years. But more importantly, understanding that every area within the Denver metro area can vary significantly on what that annual property tax rate is. So I live, for example, in Littleton in an area called Grant Ranch, and I'm sitting at right around like 1% for my annual property tax rate. There's areas, however, in Metro Denver that are closer to like the downtown areas that are really mature and established, where there's lots of homes that maybe are 100-year-old 1920 bungalow type homes, especially those type of neighborhoods. They might have tax rates as low as like 0.5 or 0.6, so like 0.5%. There's other areas, though, that are much newer build communities. One that's actually a little bit southwest of me, where I live, also in Littleton. It's an area called Sterling Ranch. I like to use it as an example frequently because they have a little bit higher property tax rate. Theirs is at 1.4%. So, for example, that $500,000 home that Ben was using as an example earlier with those different adjustable rate mortgages, let's just use that $500,000 home in an area that's very mature and established, like in Denver, where it's closer to 0.5%, you're looking at about $2,500 a year in your annual tax amount. An area like Sterling Ranch could be almost triple that. It could be about $7,000. Significant difference there. Ben, I'd love for you just to share a little bit too on insurance and also HOA, since that's such a big talking point right now.
Yeah, HOAs are in the national news, as is homeowners insurance. And when you're buying, especially if you're putting less than 20% down, the property taxes, the homeowners insurance, and then the mortgage insurance, if applicable, are going to be included in the payment. Now, if you're on a fixed rate, that interest rate is never going to change. That principal and interest component will always be the same, even if you are doing a temporary buy down. Kind of, again, if you are doing that temporary buy down, it's just being subsidized and paid for by a portion of that seller subsidy. But one thing that you do want to be aware of is just, especially if you're buying in a planned unit development or a property that does have HOA dues, is that you will never have control over that component of the payment. The payments can increase, they can go up. We are seeing a little bit of a crisis right now here in Denver, and not just Denver, but across the nation, specific to condo HOAs. And the reason for that is because there is a really big insurance crisis that's happening in the condo world right now. And a lot of these condos are underinsured, and HOA dues are now needing to be increased because the cost of the insurance for the master policy that covers the full complex of a lot of these condos has gone up, just due to some of the insurance risks that we're seeing. So that component you'll never have control over, and in some cases, what I'm seeing is that you'll have some of these condos that are priced more towards like first-time home buyers, $300,000-$400,000, but then they have a luxury buyer HOA, $500 to $700 a month, and so that is something that's real and needs to get factored in. And then also the homeowners insurance. What's nice about the homeowners insurance, though, is that you do, even though that may need to be included in the payment, you still have the ability to shop that every year. You get to choose who you're going to work with. You can change it at any time. You can cancel your current policy. You can get a new one. You can change agencies. You can change insurance companies. So you do have control over that. But again, just going back to that affordability thing, it's just something that you want to be aware of. You want to know what you're getting into. You want to know what to expect, going back to that financial vision, that financial plan. The buyers that win are having these conversations with themselves, with their spouses, with their families before they write offers, just so they can make sure that everything is in alignment with what their financial goals are.
And just one last thing before we move on, you guys. Not to keep promoting Ben here, but one thing that I love about Ben compared to a lot of other lenders that I've worked with is when I have clients that are maybe down to 2 or 3 homes that they've identified and they really like all of them and they're just really trying to see which one makes the most sense. All they have to do is just share with Ben the property addresses of the homes that they're interested in. He then does the heavy lifting. He does the legwork. He finds out all of this stuff, the property tax rate, any type of insurance quotes that are going to be applicable for that home, any sort of HOAs or metro tax districts that they might be located in, and then be able to show my clients, okay, these are the 3 homes. This is the total amount that you really need to be expecting to pay on a monthly basis, not just that loan amount, but all of these other, fees, different expenses, everything all in one, just to really be confident before, signing on that dotted line and, committing.
Hey, I appreciate that, Adam. And it also just allows for higher level decision making as well. And I'm glad to do all that because I want people to make informed financial decisions based off of their financial profile. I might come back with a payment and it might be $200 higher than what they want or what they're comfortable paying. And then it gives me the opportunity to go back and say, well, you know what? We can do this temporary buy down option. I can get your payment down below that for the first 24 months. You'll save X amount of dollars. And it allows for just additional planning, brainstorming to really make the numbers work to our favor. So you as the agent can then go back and put the deal together in a certain way that's going to then meet what the buyer is looking to accomplish.
Mm-hmm. You want to kick off the second one?
I would love to. Number 2 here is emotional decision making.
Hold on. You skipped over this one. Number 2, neglecting home inspections.
Oh, okay. I'm sorry. Neglecting home inspections. Again, this is a key mistake to avoid. Skipping a home inspection can lead to unpleasant surprises. Always know what you're buying to avoid costly future repairs. And this is what Adam was referring to a couple of minutes ago when he was referencing that crazy market back from 2019 to 2021. Buyers were waiving the inspection. They were buying a home, in some cases, sight unseen. They were one of 50 different offers. They were waiving loan contingencies, appraisal contingencies, home inspection contingencies. Yes, there is going to be a cost to a home inspection, and it can be several $100s. But remember, you want to know what you're buying. And if you're a first-time home buyer, this is going to be the biggest purchase that you've ever made. And so it's important that you know what condition is the roof in. How old is the heating and cooling element? What do the appliances look like? What's the status of the windows? You want to really know what you're buying. But more importantly, and this is why I always get inspections on every single home that I've purchased, even though there is a cost, is because number one, I want to know what I'm buying, what I'm saying, what I'm suggesting there. But number two, it can also be used as a bargaining chip as well.
Mm-hmm.
And if I find out that there's a specific concern, or it could be the condition of the water heater, or it could be the age of the furnace. I am then going to go back and say, hey, the furnace is 25 years old, maybe it's 20 years old. I would like a seller credit of $6,500 to compensate me for the fact that the unit is this old or in this specific condition. Now, you were not able to do things like this several years ago. Right now, you can. I'm not talking about trying to mislead the seller or take advantage of anyone. I'm talking about legitimate concerns with a property once you go under contract and during that inspection phase. So that is something that's happening right now. Buyers, or you can request for the seller to get the work done. I've had several deals recently where the sellers actually replaced the entire roof, not just on one, on several deals. The seller has gone in and replaced the roof prior to closing. That's happening right now. It is happening, but you have to ask for it and you have to get the inspection to know exactly what you're buying. There was another one, sewer line. I recently had a deal, and they got the inspection done also in tandem with the sewer scope, and the sewer line was not in great shape. And the reason I bring this up is because this is a very costly fix. This was like $20,000 to fix. But guess what? The seller replaced the entire sewer line. And so these things weren't happening several years ago, but it is happening right now. It doesn't mean that's going to happen on every single buyer or every single seller. But if you as a buyer, if you know what you're looking for, what your goals are, if you're working with a negotiation expert, someone like Adam, who has the confidence to ask for some of these things and have some of those unpleasant conversations at times with a listing agent or a seller, he is willing to do that. He's willing to have those conversations, and they need to be had because that one day, or that maybe it's only 15 minutes. You're submitting that offer in, that 15 minutes can save you $30,000. And that's why this is so important. I always go back to, mortgage and real estate. Chances are you probably know someone that is in mortgage or is in real estate. Most people do. It's a very saturated industry, but there are not a lot of professionals in the mortgage and real estate industry. As I mentioned earlier, less than or over 70% of real estate agents have not closed a single deal in the last 18 months. And so if you're thinking about buying a home or selling a home, you want to ask those questions. How many transactions have you closed in the last 18 months, in the last 2 years? You don't want to be working with someone that's not closing any deals. They don't have their pulse on the market. They don't know what's going on. There's a reason for that. It is a challenging market, but you want to make sure that you're working with professionals, folks that know how to plan, they know how to strategize, and they know how to have those tough conversations.
The only thing I'll add to that really quick, guys, and I can elaborate on this more if you have any questions on this after I share this with you, feel free to respond to the email that I'm going to send out after tonight's webinar, and I'll give you guys a little bit more of the details on this. But as I know, there are quite a few people on tonight that are from out of state. So for out-of-state buyers, two things that always kind of catch them off guard, since every state's different. In Colorado, The first one is what Ben just did a great job explaining, which is that sewer scope, which is only typically about $150, maybe $200 at the most, but typically about $150. And by doing that, which is an add-on, most people don't do that additional add-on type inspection to just the basic inspection. $150, and oftentimes it uncovers, something as major as a completely, cracked sewer line pipe, which could be a $20,000 repair. Or what actually oftentimes happens is, in Colorado, we have all these massive, beautiful, mature trees, and maybe the home got built in the 70s and it was just a little sapling in the front yard. And fast forward 50 years, and now all of a sudden it's this massive tree and the roots have their mind of their own. And they're, especially on older homes, they're usually clay pipes where they're, impeding on that clay pipe and creating what they call a belly, a flat spot within the pipe that can eventually lead to bigger issues like backing up into the house. So even if the sewer line's not completely cracked or broken, even just seeing little things like that belly are still, again, opportunities to bring that up in the inspection objection. And hopefully, if nothing else, either getting it repaired or just getting a dollar amount to help whenever that day comes. So that was the first one. The other one is radon. So I'm not sure if you guys are very familiar with radon, but Colorado actually is the 4th state in the nation that has the most radon of any state in the US. And radon is this odorless gas that oftentimes gets trapped underneath a subfloor. So if you have a home where there might be a crawl space, as an example, any sort of a trapped area of air, that's oftentimes when this radon gas can be in a little bit higher of levels, and it can be damaging and harmful. So we always recommend also doing these radon tests out here in Colorado. Again, it's like $100, maybe a little bit less than that, depending on who you use. And they just put this little device in the lowest part of the living space where somebody's actually going to be in the home. And they leave it there for 48 hours, and then they come back, pick it up. And if the radon levels are above 4, then that basically means it's health and safety concerns. So it's crazy just how often these radon tests are done, and they uncover a number higher than that number 4. So over 50% of the homes in Colorado have radon levels above that point. So again, very inexpensive to have that test done, and very oftentimes can get that as part of a seller concession if that level is high, because it's health and safety related. And once that seller knows that that radon level is high, if they say no to this, if they say no to you and they're not willing to do it and the deal falls apart, that's going to come back around and they're going to have to pay for that on the next person that gets under contract. So it's one of those deals that,
and they're going to have to disclose it too.
Yeah, exactly. Once they know that, same with the sewer line scope. Once they know that, they legally have to tell that to the next potential buyer. So they're very easy to get those types of concessions, those types of repairs done, just because they are so important, since they are health and safety related. And then Ben, since I've been kind of talking a little bit after you on that last point, this is another one I know you're really big on. Let's just talk about emotional decision making. Maybe just for everybody's respect for everybody's time, maybe just share that real quick story about the open house that I thought was pretty funny.
Yeah, I love sharing that story. Emotional decision making, and I always say that there is an emotional element as far as purchasing a home, especially if it's your first home or maybe it's your dream home. I remember buying my first home. I remember going down and turning in my earnest money at the Fry's off of 83rd Avenue in Lower Buckeye, and I dropped my earnest money off there. There was a Wells Fargo branch there, and it's something that you're going to remember. But you want to be very guarded of your emotions. You don't want your emotions to be the primary decision maker. It's important to have dreams and goals, and you can see your kids playing in the backyard and the family dog, and you're building a life for yourself and your family. That's important. But a lot of people make a mistake where they lead with their emotions. And the story that I share is, this was a couple of years ago. I was doing an open house with a friend of mine, and I was the open house greeter. So I was greeting folks as they came inside the open house. I'd shake their hand, introduce myself. And then while I was walking them over to meet the host of the of the open house, which was the real estate agent, I would just kind of ask them some questions. And so there was this one family, this husband and wife, who came in, and they said that they lived in the area and they were just out for a morning walk, and they saw the open house sign, and they told me that they were not in the market. They were not ready to buy. They were just making it very clear that they had no interest in purchasing. They were not in the market. So I go and introduce them to the host of the open house. I go back to the front door, and go back to my greeter position, and they come up to me about 20 minutes later after viewing the open house and walking around, and they start talking to me about writing an offer. I was like, you just told me that you were on a morning walk, getting some fresh air. You have absolutely no intention of buying. And now 20 minutes later, you're talking about purchasing what would be the largest purchase of your entire life just by viewing something in an open house for a couple of minutes. And so that is the type of emotional decision making that you do not want to lead with, because that is where regret comes from. That is where poor planning comes from. And you haven't gotten the opportunity to really think through these things. So that is what you don't want to do.
Yeah. Okay, guys, a couple last strategies before we open up to any Q&A. If anybody has any questions, first off, to stay flexible, be open to different home types, different neighborhoods. Understand that there's different options out there. There's new construction, there's older homes, there's what we call fixer-uppers or value add opportunities, homes where maybe you're at the top of your budget, but you still have dreams to make some improvements to the home once you have a little bit more cash saved up. Maybe it's a little bit older style home that's very boxy and you want a more open layout. Well, you buy that home today, and maybe in a couple of years, you've saved up a little extra money, maybe gotten a promotion or two at work, and now you can pay to have a couple walls removed and create more of an open layout. So being flexible and understanding of these different home types, as well as different neighborhoods. And then also, again, planning for closing costs, just realizing that there's a lot of other expenses outside of just the cost of the home and a loan. If you are going to have a mortgage, there's other things that you also need to be taking into consideration, not just for the closing day, but also just for the future years once you own the home. Things like HOAs, things like property taxes, all that kind of stuff. And then one last thing before we close this one out and go to the Q&A, I have a video series that I put together about a year ago. So if you guys are maybe a little bit earlier on in this process and you're just still a little bit confused about like, what does it take to buy a home? Like, how do I go through the process? What are the different steps? Well, I have a 5-part video series. It's over 2 hours of content, but you can just, pick and choose what parts of this that you want to ever consume and learn a little bit more about. Maybe you're really wanting more info on what it means to write up a contract, or maybe you have more questions about what an appraisal is or how this home inspection process works. There's a ton of info in there. So if you guys have questions, make sure you guys access that. I'll share a link with you guys again in that same email that'll be going out at the end of the night. And again, open book. If you have questions, you want me to talk through anything with you guys more specifically, or Ben for that matter, we're always happy to do so. So all that stuff's going to be going to you guys in the email tonight. Links for the latest buyer handbooks, seller handbooks, credit repair tips. That's a great one to check out. Ben has really good, valuable insights in that we didn't share on this webinar tonight, but really good ways just to, again, if you're not really maybe ready to buy for another year or two, there's things today that you can still be doing to make sure that when that time comes, you're in the best position possible. Higher credit score, understanding that maybe if you're self-employed right now, there might be some things you need to be doing today. So in 2 years, when you apply for a loan with somebody like Ben, you're actually able to get approved if you are maybe a unique circumstance, like a self-employed individual, that kind of stuff. So,
and I always point this out because a lot of people don't understand that to talk to a lender like myself, we can run an application on you. We can pull credit, not have it count as an actual credit inquiry. We have the ability to do a soft pull, and it doesn't cost you anything up front. So there's no out of pocket, there's no risk, there's no upfront cost. And I love doing that for someone who is a first-time home buyer and they want to start to explore what their options are. Or maybe, as you just mentioned, I'm not sure where my credit's at, or what are some things that I can do to improve my credit. I have some amazing credit tools where if we need to get your score up 20 or 30 points, I have this credit simulator that I can input. We need to get this individual's score up 20 points, 30 points, create a plan, and the AI will go in and say, we need to pay this credit card down by $1,000. We need to update this account. We need to add an authorized user. It'll give a very detailed plan to get that credit score up in the time frame that we're looking. So if you want to know what your purchasing power is, what your options are, what you may qualify for, are you eligible for any down payment assistance, first-time home buyer programs, any grants? With Denver being a high-cost market, we have lots of loan programs for folks with down payment assistance, grants, silent second mortgages. up to $25,000 in down payment assistance. And the income limits are very high because we are in a high cost market. So we have some loan programs where your income can be as high as $160,000, $170,000, $180,000 and still be eligible for some of these terrific loan programs.
Love that, man. Okay, let's open it up to the Q&A now. I have a couple people that I think maybe since I'm the host, they just sent their question directly to me. So I have a couple here, but I just put in also just a comment in the chat. If anybody else has any questions as we went through everything tonight, just please type them in there. And if you don't feel comfortable asking questions right now on this call, we can always, again, answer these on a phone call, on a Zoom call, on an email, text, whatever's easiest for you guys. So just be aware of that. And let's see here, but I'm going to switch up this.
Okay.
Oops. There we go. Okay. So again, guys, if you have any other questions, type them in now. But I had one question that was asked about the interest rates. Grace sent me a question asking that, we were talking earlier, interest rates right now are hovering around like 6.5%. Do you expect this to improve at all by the end of the year? She didn't say this part of the question, but I just feel like so many people are waiting on the sidelines right now and not taking action. Do you feel like there's a time, in your professional opinion, where that's going to change, where we're going to have a little bit of easing on rates, where maybe, people are going to start getting off the sidelines and back in the market more actively?
Yeah, to be blunt, it's not looking like it. Inflation and some inflationary concerns are starting to pop up again. A lot of the economic data is a little bit of a mixed bag. Oil prices are up, food prices are up, entertainment and consumer prices are also going up. Americans are spending less. Credit card debt is at an all-time high. Student loan debt is at an all-time high. The national debt and deficit are still growing. A lot of uncertainty in the Middle East and how that's going to shake out. There is going to be some administration changes, including the new Fed chair, but they're in a really difficult place. There are concerns with lowering interest rates. If interest rates do come down, that's great for folks that are looking to buy and to purchase, but that will enhance inflationary concerns if that does happen. And if rates go up, that may ease inflationary concerns, but that really puts folks who have credit card debts or are looking to get into the housing market, it really puts them under the gun. So there's not an easy answer right now. I personally, from an economic domestic perspective, I don't really see any light at the end of the tunnel. A lot of these financial analysts over the last couple of years, initially they were saying rates were going to come down in 23, and then it was 24, then it was 25. Right now we're at about we're just under a 52-week high with where rates are at. So they're the highest they've been in the last 52 weeks. But the good news is there are those loan programs. We do have first-time homebuyer programs where you can get lower interest rates. If your income is below a certain level, you will qualify for a better interest rate. We have down payment assistance. We have grant programs to help with subsidizing the down payment. We have some of those other strategies that we can use, like the temporary buy downs, to get those payments affordable. So if you have a specific concern, whether it's down payment, whether it's monthly payment, and you want to talk through it, I would love to have a conversation with you and see what we can come up with.
And then the other question I had was from Ashley, and she was saying that she doesn't know exactly where her credit score is currently, but she thinks it's in the low 600s. Is there any hope for me? Can I still qualify to buy a home with my credit score around that level? That's kind of summarized, but
yeah, 600, there is room for improvement. Don't get me wrong, but you're not disqualified. FHA will go down to 600. Our down payment assistance programs start at 620. And I have a lot of experience working with folks that have scores in the high 500s or the low 600s. And then we work on that, getting their credit scores up. And there's a lot of different ways that we can do that. Sometimes there's a small collection. Sometimes a lot of times what happens is someone is just carrying too high of a balance on their credit card. The credit utilization rate is too high. And if you pay it down, $500, $300, $1,000, I mean, that could substantially improve the scores. And so this is the part, this is kind of the mortgage playbook that the consumer is not aware of. And I'm opening the book and I'm sharing with folks how to qualify and what to do. And so that's one thing that I'm great at. I was a mortgage underwriter for about 10 years. The mortgage underwriter is the one that actually goes through and reviews the tax returns, the bank statements, the credit report, and then makes a decision. So that's one thing that makes me a little bit unique as a mortgage professional. That's one of my strong skill sets is I'm very literate on getting people to qualify for the best products possible. So my message though to anyone is, the mistake, and this is a Warren Buffett philosophy, people make mistakes when they try to time the market. You shouldn't be trying to time the market. It's time in the market. And that doesn't mean that you drop right now what you're doing and go purchase if the time is not right for you. You do want to make sure the time's right for you. But talking to a lender and putting that plan together and thinking of those next steps, that's why it's so important. Because when you have that plan, when you know what you're looking to accomplish, when you know what you want that monthly payment to be, are we going to be looking at down payment assistance? Are we going to be looking at temporary buy downs? What's great about our down payment assistance programs is earlier this year and this also has to do with affordability. We now allow interest rate buy downs on our down payment assistance, so you can actually combine a down payment assistance and an interest rate buy down into one loan. Whereas a year ago or several years ago, you could not do that. And so just really creative strategies and tools and resources out there. Again, most people are not aware of this, but it's here, it's happening. People are taking advantage of it. I have done probably 15 plus down payment assistance loans this year, 2026 year to date so far. Like it is happening. I have done probably 10 plus either 2-1 or 3-2-1 buy down loans this year. This is all in the last 5 months. So I closed one on Monday. So it's happening. It's real. It's not something that we're just talking about. It is really happening.
Yeah, unless there's any other questions, I think one just kind of to close us out, just one last little very quick story, Ben, is just sharing with them just a little aspirational, but it's real. This is very, maybe aspirational wasn't the right word. Very achievable, real, true story here is how you just had some clients. I don't know if that was maybe a month or two ago at this point, but you literally had them come to the closing table with $1,000. So literally were able to buy the home, not $4,000, but they literally came to the closing and all they had to pay out of pocket was $1,000 because they had some of these, really good CHFA, I think it was Colorado Housing and Finance Authority. Anyway, just maybe share a little bit of that as we wrap up.
Yeah, and so it sounds crazy. It sounds like it's too good to be true. But again, though, what it takes planning, and the offer has to be written a certain way, and the lender, the buyer, and the real estate agent all have to be in alignment with what the plan is and how we're going to go and accomplish that. But the way that you do that, this is how you do that. So you get a down payment assistance loan that the customer qualifies for, and there are several. We currently offer over 15 different reduced down payment or down payment assistance, the form of a grant or a silent second mortgage. So it includes incorporating one of those loan programs. That's step number one. Step number two is getting a seller concession from the seller. So we get a seller concession for anywhere from $10,000 to $15,000, depending on the sales price. And then we use a portion of that seller concession to buy the interest rate down a little bit further, as I was saying, to make the payment more affordable. And then we'll have the earnest money. Usually it's around 1% of the sales price. So if the home was $500,000, that earnest money was $5,000. Now, when you have a down payment assistance loan with a seller concession of $12,000 and an earnest money of $5,000, I will one up you. There have been several times this year where I have had buyers get money back at closing. The title company has handed them a check for $2,000, $3,000, $4,000 when it is structured in that manner. It has to be structured correctly, but we've had buyers that have gotten checks back, and the reason they're getting the check back is because the down payment assistance is paying for the down payment. The seller concession is paying for the closing costs. And so they're then getting most of their earnest money back. There is $1,000 contribution that they have to make. And so that's why they can't get all of the earnest money back, because they do have to have at least $1,000 invested. But if the deal is structured the right way, It is literally possible to get into a home in Denver, Colorado right now with as little as $1,000 out of pocket and get most of your earnest money back at closing.
That's awesome. Very inspiring to hear that. All right, guys. Well, I didn't see any other questions pop in. So feel free, though, again, you guys, if you have questions still, we're always happy to answer them for you. I'm going to share Ben's info in that email that goes out later tonight, just to thank all of you for joining us. And with that being said, Ben, thank you so much again. Really enjoy hosting these with you. You're a wealth of knowledge and just always feel a little fired up afterwards, just about kind of counteracting all the negativity going on right now in the news and just in the world right now. There's still ways that people can better themselves, improve their future, and still take advantage of this awesome opportunity if it makes sense for you guys. Everybody has their own unique situation, but there's so many opportunities out there right now if you just know where to look.
Let's find out if it makes sense for you. We love you guys. Thank you for your time. We know how valuable your time is. And if this is important to you, it's important to us. You're welcome to schedule a call. You're welcome to reach out. We love having these types of discussions. I love doing strategy calls. I just love talking real estate, mortgage. I'm here as a resource. So is Adam. Have a great night, and we will stay in touch.
See you guys.